Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
We just don't have a lot of economic data. There's a lot of uncertainty out there in the marketplace as to where this economy is. I don't know how people do it who actually get paid to do this stuff for a living. Like our next guest, Seema Shah, Chief Global Strategist at Principal Asset Management. Seema, what are you making of the last, 2-3 weeks? The market seemed to be just a little unsettled here. I mean, there's only a 3% drawdown in the S&P, nothing to really write home about. But, what do you make of some of this uncertainty we're seeing in the marketplace?
Good morning, Nathan. Yeah, absolutely. This has been a really, really rocky market. And it's been interesting because I think what the shutdown did, it just created this vacuum, which has allowed some really kind of negative narratives to take root. And the key one is that how the Fed isn't going to be interpreting the direction of the economy. I think coming into the shutdown, the general consensus was that the doves on the FOMC would have the upper hand and almost assuring a December rate cut. And if anything, what's happened is actually the more hawkish members have seemed to become a little bit more dominant. And as a result, we're in this point where now the odds of a Fed cut in December is just down to 50-50. And it really is rattling the market, partly because we just don't have a clear narrative, as you said.
So I'm looking at the VIX index, of course, that's Wall Street's fear gauge. I'm seeing it sitting around the 22 handle. What do you make of the current volatility in the market? Do you expect it to sort of temper out here?
I mean, I think it could once we start to get a clearer direction. But again, it really does depend on how the Fed is going to respond. I think that's one thing. And then, of course, there's the AI story. And those fears seem like they're really taking root. You don't want to jump to any conclusions because, of course, you've got the NVIDIA earnings report coming. So everything could just completely turn around if that's a good release and start to, once again, put some of those fears to bed. But at least, as we're going into 2026 and we are expecting a bit of an economic slowdown, a bit of a labor market slowdown, that is typically the time when you start to see some of these fears really start to take root, particularly when you consider it from a late cycle narrative.
Seema, we just in the process of finishing up this third quarter earnings release, and by and large, earnings were really pretty solid, low double digit kind of growth rate there. Is that enough to support this market, Seema?
It should be. I mean, typically, you just need to have positive economic growth, driving positive earnings growth. And ultimately, the S&P 500, for example, is very, very tightly correlated with that earnings performance. So it should do. Now, of course, there's going to be some bumps along the road. And when you look at valuations, particularly for those big tech companies, there's going to be moments, potholes, air pockets, whatever you want to call it, where the market really does have that moment of hesitation where they really start to question the direction. But the key thing for us is, look, as long as you can continue with positive growth in 2026, maybe a little bit lower than what we've enjoyed in 2025 on the whole, but as long as there's positive growth, then really you should see this continuation of earnings growth, and that should be enough to support the equity market. We're not, of course, expecting very significant gains through next year, but at least, an upward trajectory where it does become important where you're going to be positioned, which are the companies, which are the sectors.
Seema, so you mentioned you flicked at the idea there's a lot of fear surrounding AI. We've been hearing so much talk about market valuations being too high. So where do you want to be in this market?
So we do have overweights to that mega cap trade. We, as like everyone else is in the market, it's been really important to start to continue the analysis of these companies and looking at valuations. Now, look, valuations are frothy, that goes without saying. But I think the comparison to the dot-com bubble is very much exaggerated. We have been very much reassured by the fact that the balance sheets of these companies are very strong. But there are concerns, and the concerns that we need to track. One thing which is driving it, which I don't think is going to be answered at any time soon, of course, is how it's going to be delivering on all of that productivity potential that people are hoping for. And that simply will not be answered anytime soon. So then the key thing that we have to be keeping a track of is how they're financing all of that AI capex. Is this debt financing becoming more of a trend, in which case concerns around a bubble are going to increase if it's not matched by profit growth? So I think we're at the early innings of kind of some of these concerns, which unfortunately doesn't mean it's going to grow. But as long as these companies can continue to deliver on the earnings side, we do think it can, dispel those fears as they continue to grow. So it's an upward trajectory, but very, very noisy.
Seema Shah, thank you so much. We always appreciate getting a few minutes of your time. Seema Shah, she's a chief global strategist, principal asset management, located over there in the city of London. Appreciate that. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Let's switch gears to commodities. A lot going on out there in the space here. I don't know. I'm getting ready for the next season of Landman, which means I focus on oil. And I see WTI crude oil below $60. I like that as a consumer, but I know the folks in the patch don't like that. They like $75.
Of course.
Cost of production's, I don't know, mid-50s, so they're making some good scratch there. But it's down here at 60, they're not so happy. We got somebody who does this stuff for a living, Francisco Blanch, head of global commodities at Bank of America Securities. I know them as Merrill Lynch back in the day, but they can call themselves whatever they want these days. Francisco, thanks so much for joining us here in our Bloomberg Interactive Broker studio. On the commodities front, what do your clients want to talk to you about these days?
They want to talk about oil. They want to talk about gold.
Yep.
They want to talk about what's going on in the metals space, some of the tariff impact on agriculture, and I think they also want to talk about power and AI.
All right, let's go with the power and the AI story, because that's kind of a new thing. AI has been such a theme for this marketplace, certainly for the tech stocks that have direct exposure. And then people started looking for derivative plays, and they come to your world, which is, how are we going to power all this stuff? How does that impact kind of the commodity discussion in terms of power?
So the biggest impact, the most direct impact, has been perhaps on the metals markets, right, which are kind of the pick and shovels of electricity.
Yes.
You've seen that in the price of copper. You've seen the price of silver. And we expect it to continue over the course of the next 12 to 18 months. So we are bullish on those two commodities. Just to be clear, we have a $15,000 per ton copper target over the next 24 months. And we have over the next 12 months or so, we got a $65 an ounce silver target. So we're bullish on those two commodities. They're key, the best and the second best electricity conductors in the world, right, as a commodity. So we think those two make sense. Strong exposure to solar panels, to grid. Also, people want to talk about gas and how gas powers electricity. In the U.S., we've seen a big ramp up in Henry Hub prices. You may have noticed that we are now trading around $4.50 in MMBTU. That's a pretty big pickup. And remember, gas is in the U.S. been hit by two things. First, demand for power has been very strong, although that's not really the reason why gas prices have risen. It's because of the LNG export story to power the rest of the world. And of course, the U.S. launched a large investment into LNG export facilities, liquid natural gas export facilities. These are coming online very quickly. They are soaking up all that gas, freezing it, and shipping it to Europe and to other parts of the world. And that's been the true story for the last few months, and will remain the big story for the next few months. So we're not super bullish, in part because we think producers are very good at cranking out output. So you talked about oil and how folks need higher price than $60 a barrel to get a decent return. But for gas, the number is a lot lower than $4.50 in MMBTU. So we're going to see a ramp up there in activity.
So you're the expert in commodities, but I have the GLCO Go function on the Bloomberg terminal, the global commodities, so I can see everything. And I can be at a cocktail party. I can sound like an expert.
Honestly, I wanted to stick with that AI play that we were talking about a bit earlier. What are some other maybe derivative plays that you think maybe investors are underappreciating during this time period?
So we like. In the commodity world, you can also look at power prices themselves, and we think those power prices are likely to continue to go up. Wholesale power prices. We've seen capacity auctions very strong across, particularly in PJM in the Northeast. There's a huge data center build out, as you know, going on in Virginia. It's having a political implication as well, right? We've seen the cost of living remaining a core issue in elections. and we expect it to remain so because it's we don't really see the pressures fading away. But one derivative side of power, right, is perhaps the most underappreciated is aluminum. Aluminum is essentially solid electricity. When you have a lot of spare electricity, you basically can make very cheap aluminum because it takes 14 megawatt hours of power to make a ton of aluminum. So we expect aluminum prices to also rise quite significantly. And it's interesting because aluminum is one of the commodities that has been subject to a 50% tariff, even though it's really a Canadian import. So we expect aluminum prices to continue to trend higher globally. That's one area we think as a result of the AI boom. I mean, it's essentially solid electricity.
Looking at WTI crude oil, roughly $60 a barrel, Brent $64. Is there an oil glut out there? Are we in a period of prolonged oversupply in crude, do you think?
We are, and that's it's interesting because we talk about all this energy demand, and here we are with really depressed crude oil prices. So what's going on? Simply, we have a price war right now between OPEC plus and rest of the world. For the last 3 years, in 22, 23, 24, price of oil averaged almost $90 a barrel on Brent and mid-80s for WTI. But you know what? U.S. production went up 3 million barrels a day. Saudi production went down 2 million barrels a day. They cannot keep doing this forever. And they're like, well, $90 oil doesn't really work for us. It works too well for you, but it doesn't really work for us at all. So we got to get some of that market share back. And that's what's going on. They've been adding a lot of barrels. And that's depressed prices. We've averaged about $69 a barrel in Brent this year, about $4 under for TI 65. Last year we averaged around 80, right? So it's honestly, like, there is a glut. And OPEC 10 days ago decided to pause. Partly because they thought, well, maybe there's too much oil in the market. We're going into the first quarter, which is seasonally weak. So let's put a pause on things here. Because OPEC doesn't want to run a price war like 2020 or 2015, right?
You're based in Madrid, correct?
I am now, yeah.
Okay, here's the problem I have with Madrid, and maybe Spain in general.
Tell us, Paul.
I'm an early to bed, early to rise kind of guy. These people don't go out to dinner until like 9, 10 o'clock at night. What is up with that?
All right, so just a quick historical fact.
Give us a history.
Please.
About 100 years ago, maybe 90 years ago, Spain changed the time zone to align it with Paris and Berlin.
Okay.
Right?
Really?
So Spain has a time zone which is aligned with really. Today, if you go to Warsaw, it's the same time zone as Madrid. It doesn't make any sense because if you think of the Greenwich Meridian, it crosses straight through Valencia.
Okay.
So the whole of Spain should be on UK time zone, not on German time zone. But that's kind of something that happened 90 years ago, and nobody seems to have been willing to change it. There's a big debate in the country as to whether that makes any sense. Should we change that? Well, people love going out. It's also pretty horrific. You wake up sometimes 8 in the morning, 8:15, still dark.
Oh my goodness!
I mean, it is a phenomenal city. Love
that must be jarring.
Madrid. It is awesome. Francisco, thank you so much for joining us. We appreciate it. Francisco Blanch, he's head of global commodities at Bank of America Securities, based in Madrid, but joining us live here in our Bloomberg Interactive Broker Studio, and we appreciate that. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Hessam Nadji joins us. He's the CEO of Marcus Millichap. That's the business that he does. Retail, commercial, all that kind of stuff. He joins us here in studio. Hessam, talk to us about the country here in retail, commercial, real estate. What's the market look like?
Good morning. Great to be with you again. Retail has a short-term and a long-term picture that we have to talk about in order to really express the current state of the market. The long-term picture comes from pain. 20 years of reinvention of retail, e-commerce killing brick and mortar, and the industry stopped building any new product for the most part, and repositioned so many shopping centers and retail concepts. And we've come out of that much tighter and a reinvented way of using brick and mortar retail, which is now being very successful. It's all pretty much driven by fitness, entertainment, food, and destination shopping. Those things are moving in a very positive direction. In the near term, because wages have been growing and consumer confidence has been really high, and high net worth individuals have been spending thanks to the stock market and other wealth creation mechanisms, sales have been really, really strong. So two very short-term and long-term positive factors going. Some of the headwinds are the uncertainty related to interest rates, tariffs that made many retailers pause for a moment in store openings and balancing, forecasting where consumer confidence may be going, which has weakened in the last few months. So it's really a battle between some of that uncertainty and very strong fundamentals.
So during the break, you were talking to us about how some of the retail spaces are performing well in suburban areas. Talk to us a bit about what it looks like regionally as we think about demand for retail space. You
mentioned New York right here at the heart of the capital markets epicenter of the world. We're creating 70 to 80,000 jobs a year. New York is back, yet there is a lot of urban retail storefronts that are still empty or struggling. The consumer habits, the tourism hit that we took earlier this year, all those things play into street urban retail. Suburban retail, on the other hand, has been doing much, much better. And I would say urban retail is on the recovery, but not quite as strongly because the post-pandemic effect of a lot of people fleeing urban markets. That's changing, thank God, because of the mandate to return to office, which is also helping to improve both residential and retail.
Now that I think about our Lexington Avenue, 58, 59, I mean, whoever owns those buildings or manages those buildings, they're doing a bad job. I could sell that stuff. I could sell that stuff. I mean, it's prime location. People are back. It's packed.
Or so I think so. Right?
I don't get it.
Well, you just hit the most important part of creating wealth through commercial real estate, and that is, what are you going to do with the asset?
Yeah.
Why did you buy it in the first place? How did you finance it? What was the value in and your expected value out? And in between, what are you going to do to create value and make the property stand out? At the end of the day, it's the business execution of that strategy, asset by asset.
Yeah, they got the signs in the window. I'm going to call that number and say, dude.
Give them a ring, Paul.
Yeah, get going here. All right, interest rates are coming down, and that's good for your business. How good for your business?
Really fascinating to see what's happened with commercial real estate as a whole. We have three very positive forces working for the industry. One is price corrections. Since 2022, peak March of that year, prices have gone down on average 15 to 20% across the entire industry. Interest rates are coming down as a second positive. And more important than that is the fact that financing is back. Banks are lending again. Credit unions are lending again. And that doesn't capture much headlines because more than 80% of all transactions in commercial real estate are sub $10 million executed by high net worth individuals and high net worth households, not institutions. And when debt becomes more available and lenders are more confident, the lender spreads come in. And that's why interest rates are coming down. The only real headwind we have is this uncertainty around the government shutdown and the data that the Fed relies on, and all the question marks about the effect of tariffs on inflation and what the Fed will or will not do. That's pretty much the only real headwind we're facing. Fundamentals look really great.
So in my previous role, before I became markets correspondent for Bloomberg Television, I was on our equities team. Aw, thanks, Paul. I was on our equities team and I covered real estate stocks. I covered REITs in particular. And I was surprised to learn that office REITs only make up about less than 4% of REITs more broadly. So a lot of people look at commercial real estate as bad because of struggles in office. But it's really conflating that idea and really making it broadened out for the broader sector. But what other areas are you keeping an eye on? I know I used to cover senior housing a lot. Is that an area that you're looking at as we think about the baby boomers?
Absolutely. We do business in 16 subcategories of commercial real estate: self-storage, manufactured homes, land, of course, medical office. We cover all those property types. And even within retail, there is a huge divergence of shopping centers versus fast food, single tenant, or auto part single tenant properties. All of those different subsectors have their own cycles. And within office, it's interesting you say that, because during the banking crisis of 2023, there was so much concern that commercial real estate was the next shoe to drop and put pressure on the banking system. And when you look at the total outstanding loans held by U.S. banks, there's less than a 5% total exposure through office. Wow. And not every office building is distressed. I mean, by far. In fact, suburban office vacancies have been running around 11%. It's the urban older assets that have 30% vacancy rates. So there was a lot of misperception about the impact of the whole post-pandemic office issue.
Private credit, to what extent is it playing a role in your business?
It played a very significant role in 21 and 22 when debt funds were issuing loans at very aggressive underwriting and very unrealistic rent growth assumptions. Those loans are terming out, and there isn't as much private credit to absorb all of those. So some of those assets are having issues and are distressed.
All right, Hessam Nadji, thank you so much for joining us. Hessam Nadji, he's the CEO. Marcus Millichap joining us live here in our Bloomberg Interactive Broker studio in New York City. Stay with us. More from Bloomberg Surveillance coming up after this.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
The highlight of every Bloomberg surveillance program is the newspapers. Lisa Mateo, what do you got for us?
All right, we're going to go up here early. This whole, the fight for Warner Brothers Discovery, right? It has a deadline nearing. So this is in the Wall Street Journal. Their sources are telling them Paramount, Comcast, Netflix, they're preparing bids for an initial cutoff to submit non-binding first-round bids by November 20th. They say Warner Brothers Discovery hopes to have it wrapped up by the end of the year. And then you go to this article from Bloomberg on the terminal. It says Warner Brothers Discovery amended the contract of CEO David Zaslav to make sure that his stock options remain eligible to vest even if the media company is sold.
Wow. So Zaslav always gets paid.
He does.
Year in, year out, he is usually the highest paid media executive. And that's just a function of the way they do their stock compensation, but good for him. Here's the problem I have with this deal.
Okay.
I've called all my banker buddies on the street. Nobody's talking to me because they're all hired by somebody, one of these parties.
That's involved,
Everybody's
right?
engaged. Everybody's engaged and nobody can talk. So I'm like,
many conflicts.
I can't talk to you, Sweeney, because, we got a deal going. So, but I guess something will happen sooner, right, Lisa?
I hope so. I mean, aside from the stock options, remaining eligible to vest, they're also saying that his employment term would extend to December 2030 under certain conditions, and his agreement ran through 2027. So they're extending
All right, well, he's taken care of. So
he's taken care of.
I think we can all feel better that the CEO is taken care of.
What's interesting, too, is that so Paramount just wants, the whole company. But then you have different ones like, other companies like are just looking for the movie
Comcast
and television
and Netflix.
side.
Right.
Yeah.
Some of them
Because the cable network business, which was the jewel of Time Warner back in the day. You think about all the Turner networks, TNT, TNN, CNN, all that kind of stuff. Those businesses, which were the gem, which were the profit drivers, which were housed most of the value, they are in a secular decline due to cord cutting. So a lot of people just don't want that business these days.
That's what
All right. What else we got?
Okay. You were actually just talking about this in a previous segment. So the tough news for the class of 2026, they're 6 months out from graduation, and now it doesn't look so great as they look for a job. There's this new poll. It's from the National Association of Colleges and Employers, and it shows that more than half of the 183 employers surveyed, they rate the job market for that class as poor or fair. Of course, the economic outlook, right? They're hiring more conservatively. AI, you've talked about it, that it's taking over more tasks that usually these kids are tapped to do, like those entry-level positions.
Right.
A lot of companies giving priority to recruits with some experience instead of the fresh from college ones. So now you have these college seniors who are competing against junior workers who've been laid off, so it's this whole circle that they're kind of dealing with.
It's a tough market right now. I feel like it's so competitive. To your point, imagine coming out of college, but you're competing with people who already had experience.
Correct.
And were recently laid off. So it's really hard right now for them.
There you go. All right.
Miss
last one. Universe?
Yes.
That's still a thing?
Miss Universe. Okay, so there's a battle brewing over this whole pageant. It's not a cat fight between the contestants, okay?
Okay.
It's a fight between the two men that are running it. So on one side, you have this Mexican businessman, right? He's the president of the Miss Universe organization. Then on the other side, you have this Thai entrepreneur. He owns a franchise in Thailand. That's what hosted this year's competition. So the issue is that, pageants are facing, they're trying to stay relevant. irrelevant, right? It's the age of algorithms. They're trying to do what they can. So the Thai entrepreneur, he wants to transform it into like influencer driven, and they're pushing products, so he wants to try and make money that way. But the Mexican businessman saying, you know what, I don't want to do it. I want it to remain like this empowerment platform for women. So it's this battle back and forth, and it got so heated that you had the Thai entrepreneur fighting with Miss Universe Mexico. It went online, like it went viral. It's this whole behind the scenes thing, contestants storming off. So yeah, it's becoming like
the drama.
Well, now I might pay attention. I might pay attention to it.
Might need to tune in, right?
I didn't know it was still a thing. Beauty pageants are still big in Latin America, I read in this article, so we'll go figure. All right, Lisa Mateo, newspapers, thank you so much. We appreciate that. The highlight every day. We kind of span the newspaper business here.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.